Scan now. Meet Sovi, your new AI study buddy.
Nation J's unemployment is rising, and this macro question is about matching fiscal policy with central bank action to keep short-run interest rates stable. First, if unemployment is increasing, the government uses expansionary fiscal policy to boost demand, output, and hiring, especially since the budget was balanced before this policy change happened. That fiscal expansion tends to push interest rates upward, so if the central bank wants rates stable in the short run, it must offset that pressure with easier monetary policy. Among these choices, the matching move is targeting a lower policy rate, which keeps borrowing conditions from tightening, so option C is the correct answer. Well done! Option C. Scan now, watch signs, avoid rush, trust given information, and check steps. So fiscal expansion and stable rates point to easier,